What does GFC stand for? B. Global financial crisis. Global financial crisis, or GFC, is a global economic decline that lasted from 2007 to 2009, which resulted from the collapse of the housing market and investment banks. There was a severe recession in many nations around the world as a result of the crisis, quick spread to other economic sectors. The aftermath of the crisis was long-lasting, with many economies struggling to recover and experiencing slow growth for years afterwards. What are the causes of the GFC 2008? All of the above: subprime mortgage loan, housing market bubble, and lack of regulation. Mortgage lenders lowered their lending criteria and granted the subprime mortgage loans to borrowers who weren't eligible due to their bad credit. The widespread issuance of subprime mortgages that were packaged into sophisticated financial products and marketed to investors caused the housing bubble in the United States to burst. Because of the bubble, it caused home prices to plummet, hence causing many borrowers to default. Adding to that, there were also failures by the government on their duty to regulate the financial industry, in which they failed to surveil the banks that keep on giving mortgages to people who subsequently proved to have a bad credit risk. Credit rating companies also came under fire for granting high ratings to debts that later turned out to be risky investments. They failed to recognize dangers that might have prevented investors from buying certain kinds of debt, like mortgage-backed securities. What are the effects of GFC? All are correct: high unemployment, house price decline, and stock wealth lost. High unemployment. Global unemployment rates significantly increased as a result of the GFC. Businesses used cost-cutting measures, such as hiring freezes and layoffs, as they suffered. Many people are either unemployed or have low levels of employment due to the fall in economic activity and the shrinking of industries. House price decline. Property values dropped as a result of the collapse of the housing bubble and the ensuing financial crisis. Many homeowners were in a situation of negative equity, where their mortgages were more than the value of their homes. For homeowners, mortgage lenders, and the construction sector, the housing market fall had serious aftermath. Stock wealth lost. Significant stock market falls were triggered by the GFC globally. Individual investors and institutional stakeholders' wealth has diminished as a result of the sharp decline in stock prices. Significant losses were incurred in pension funds, investment portfolios, and retirement savings. Investor confidence, consumer spending, and the health of the economy as a whole all suffered greatly from the decrease in stock market values. Did the GFC affect the Islamic capital market? Yes, the Islamic capital market was affected by the global financial crisis, GFC, but it was more resilient than conventional markets. The consequences of the crisis were mitigated by Islamic finance's commitment to Sharia regulations, which forbid interest-based transactions and support asset-backed investments. Islamic financial institutions displayed steadiness during the downturn and had lower exposure to riskier assets. Although the Islamic capital market slowed down, its emphasis on morality and practical investments helped to maintain its relative stability throughout the recession. What can Islamic finance learn? To follow the Sharia guidelines. Islamic finance can emphasize the importance of ethical and responsible practices in financial transactions. The GFC highlighted the detrimental consequences of excessive risk-taking, unethical behavior, and lack of transparency. By prioritizing ethical considerations, Islamic finance can promote greater stability and integrity in the financial system. By focusing on Sharia guidelines, Islamic finance can navigate the challenges and pitfalls revealed by the GFC. Emphasizing strict compliance, avoiding speculation, promoting asset-backed financing, incorporating ethical investment criteria, and enhancing risk management practices will contribute to a more stable and resilient Islamic financial system. Additionally, staying within the Sharia guidelines can ensure the effectiveness and strength of regulations while also keeping people in the industry to uphold good morality in conducting transactions in the Islamic finance. What is one of the specific lessons learned by Islamic finance from the failures and weaknesses exposed by the GFC? Avoidance of excessive risk-taking. Islamic finance understood the risks associated with irrational risk-taking and speculation, which were major factors in the GFC. Islamic financial institutions have discovered how crucial it is to take a cautious approach to risk management and make sure that financial transactions are supported by legitimate economic assets and operations.